In the previous video on how to hold for bigger gains, I told you that the real money in the market isn't made by jumping in and out every few minutes. It's made by sitting tight when you're right. But before you can sit tight, before you can even be right, you've got to recognize when a trend is about to begin. That's what separates the ordinary player from the professional speculator. And that, my friend, is what we're going to talk about today. Now, here's a truth most traders never grasp. A trend doesn't shout when it begins. It whispers. It starts quietly, beneath the surface, long before the headlines catch on. You won't see fireworks. You won't hear the crowd cheering. What you'll see if you're paying attention are the signs. And those signs, subtle as they may be, are worth their weight in gold. Have you ever noticed how the public always seems to discover a stock right after it's already made its biggest move? That's because they wait for confirmation from the crowd. But the professional doesn't wait for the crowd. He listens to the tape, he studies the chart, and he acts when the market gives him its quiet signal. One of the first signs a trend is about to begin is a change in character. The stock starts behaving differently. Maybe it stops making new lows, maybe it tightens up in its range, or perhaps volume begins to dry up after a long decline. That's the market taking a deep breath. It's resting. The selling has exhausted itself. The professionals are quietly accumulating while the amateurs are still fearful. You can almost feel it when you've watched enough markets. You see, a stock doesn't move because of what you think it moves, because of supply and demand. When the selling pressure runs out, even a small bit of demand can start pushing prices higher. And when that demand keeps showing up day after day, week after week, that's the foundation of a new trend forming. The chart starts to build its story one candle at a time. Now ask yourself, how many times have you ignored that early shift because it didn't look exciting enough? Most traders want action. They want movement, noise, confirmation. But the great trends don't start that way. They start in silence. They start when nobody cares. Another sign, and this one is worth your closest attention, is the test of a key level. Watch how price behaves when it revisits an important support or resistance zone. If a stock fails to break lower after multiple tries, if it starts bouncing off that area with higher lows, that's a clue. That's the market saying, the path of least resistance is changing. And remember, in this game, the path of least resistance is everything. But don't mistake a bounce for a trend. A bounce is emotion. A trend is conviction. You'll know conviction by volume, that invisible hand that reveals who's in control. Rising prices with expanding volume show demand stepping in. Falling prices on light volume show the sellers losing interest. The tape doesn't lie if you know how to listen. And this is where your mindset as a trader matters. Most people want certainty before they act. But by the time the move looks certain, it's already halfway over. That's why the market pays the man who has the nerve to act on probability, not perfection. You must learn to read those early signs and have the discipline to wait for them, not to chase, not to guess, but to recognize. Do you recall how in that last discussion on holding for bigger gains, we talked about the patience required once you're in a trend? Well, that patience begins long before the entry. It starts here, waiting for the right moment, when the tide first begins to turn. The man who learns to wait for the beginning earns the right to sit through the middle. Now, one of the clearest signals I've seen over decades of market study is what I call the quiet breakout. It's not the dramatic, headline-grabbing surge that everyone notices. It's the slow creep through resistance after a period of tight consolidation. The best trends often begin this way, quietly, methodically, with low volatility. Then, when the move is already in motion, the crowd wakes up, rushes in, and gives you the liquidity to ride the wave. But here's the irony. By the time the newspapers start talking about that hot stock or that new trend, it's already too late. The professionals are selling to the very people who laughed at them a few months earlier for buying it. You can see it again and again in every cycle. History may not repeat exactly, but it rhymes perfectly in the markets. Let me ask you, are you the kind of trader who waits for permission from others, or do you trust your own observation? Because that's what this really comes down to: independent judgment. You can't be swayed by tips, by talk, or by emotion. The signs that a trend is about to begin don't show up on the news, they show up on the chart. Watch how the leaders act. When the market as a whole is struggling, but a few names keep holding up, that's a sign. Leaders lead. They don't wait for confirmation from the index. They move first. And when the general market turns up, those leaders explode higher. That's your cue. You must also understand the rhythm of accumulation. Professional money never buys all at once. They accumulate slowly over weeks, sometimes months, keeping prices from running away. That's why the early part of a trend looks so boring to most people. The professionals are buying from the impatient, the fearful, and the uncertain. Then, once they've filled their positions, the real move begins. It's the same pattern that repeats: accumulation, markup, distribution, markdown. Your job is to spot the transition from one phase to the next. The beginning of a trend is that quiet shift from accumulation to markup. The chart tightens, the lows stop getting lower, and suddenly, strength begins to appear where there was weakness. Now, I want you to think about this: what's more dangerous, missing the first 10% of a move, or being trapped in a false start because you couldn't wait for confirmation? That's where skill meets patience. You don't have to catch the absolute bottom. You only need to catch the right beginning. Every great operator I've ever known made his fortune by understanding when a trend was truly starting, not just moving. That's the art. That's the skill the tape teaches you if you care to study it. You don't rush it. You don't predict it. You let the market reveal it to you. And here's the most important part: when you finally see those signs, when the trend begins to form, you must act. The market rewards decision. Hesitation kills opportunity. But once you're in, that's when everything we talked about in how to hold for bigger gains comes back into play. Because the beginning of the trend is only the invitation. The fortune lies in what comes after. So watch the tape. Study the character of price. Listen when the market starts whispering, because those whispers, if you can hear them, are where every great trend is born. Recognizing the early signs of a trend grants the trader the chance to hold for bigger gains later. That's the essence of professional speculation: the ability to see before others see, to act before others act, and then to sit tight while the crowd scrambles for scraps. You can't hold for bigger gains if you don't first catch the birth of the move. That's why this principle is so vital. The beginning sets the tone for everything that follows. When a trend first starts to form, it doesn't announce itself with fanfare. It's quiet, uncertain, sometimes even dull. Most traders ignore it because it doesn't look like a trend yet. They want obvious confirmation: big candles, strong momentum, flashing signals. But by the time it looks safe, it's already expensive. The market pays those who recognize the shift, not the spectacle. That's the difference between the early operator and the latecomer. Think about how the market moves in cycles: accumulation, markup, distribution, markdown. The biggest gains always come in that markup phase, the moment when demand begins to dominate supply and prices start to move steadily in one direction. But if you wait until everyone else sees it, the easy part of the move is gone. That's why reading the early signs is so crucial. The earlier you spot a genuine trend, the more room you have to ride it. Now, what are these early signs? They aren't found in headlines or opinions. They're found in behavior: price behavior, volume behavior, and the rhythm of the tape. You might notice that after a long decline, prices stop falling so sharply. The down days become less severe, the up days start showing strength, and the range tightens. That's the market shifting from weakness to stability. The professionals are absorbing shares while the public is still fearful. Volume. Two tells a story. During that quiet period, you'll often see low volume on declines and slightly higher volume on rallies. That's a clue. It means selling pressure is drying up, while smart money is beginning to test the market on the buy side. It's subtle, but it's there if you know what to watch for. You don't need complicated indicators. You need to observe with patience and clarity. When that early accumulation begins, your job isn't to jump in blindly. It's to prepare. to study the structure forming on the chart, to mark the key levels where a breakout would confirm the beginning of the new move. Most traders lose here because they either act too soon guessing instead of waiting, or they act too late after the move is already well underway. The balance lies in disciplined observation. Have you ever seen a stock that just refuses to go down, even when the market is weak? That's a leading sign. Strength in the face of general weakness means strong hands are in control. The market is trying to tell you something long before it speaks loudly. It's like a poker game. If you can read the tells, you know who's holding the strong cards. The tape always reveals its secrets to the patient eye. Recognizing the early trend doesn't mean predicting it. That's where many traders make their mistake. You're not trying to be a fortune teller. You're trying to be a detective. You look for evidence, not emotion. When the clues start to line up higher lows, steady volume increases, leadership from key sectors, you begin to sense that the tide is turning. That's when you position yourself strategically, ready to move when the confirmation comes. And once you recognize it and act on it, the real discipline begins the holding. That ties directly back to what we discussed in the previous idea about holding for bigger gains. You can't hold for bigger gains unless your entry was based on a strong foundation. A weak or random entry shakes your conviction. But when you know you caught the early signs, the true beginning of the trend, you have the confidence to stay in through the normal fluctuations that shake out the crowd. It's the difference between a trader who's guessing and a trader who's knowing. The guesser fears every pullback because he doesn't understand where the move began or why it's happening. The observer, on the other hand, understands that a strong trend has natural pauses. He knows the context. He knows the character of the move. That's what allows him to sit tight and let the profits mature. Let me ask you, how many times have you sold too early just because you entered too late? When you jump in mid-trend, every small dip feels like the end. But when you've recognized the beginning, when you were there, at the turn you see those dips for what they are, opportunities to add, not reasons to panic. The early recognition gives you perspective, and perspective is power in trading. Another advantage of catching the early signs is the favorable risk to reward setup. Early entries, when confirmed properly, allow you to define your risk tightly. Your stop can be close because you're near the base of the new move. That means smaller losses when you're wrong, and much larger gains when you're right. It's the mathematical edge that separates professionals from gamblers. The market always rewards preparation. Those who wait for certainty never get it. Certainty is a luxury that comes after the profit has already been taken. The early trader acts not out of hope, but out of observation. He doesn't need the crowd's approval because he trusts what he sees on the chart. That quiet confidence is what allows him to hold through noise and volatility, collecting the gains that come only to the few who had the nerve to see early and stay long enough. Every major fortune built in markets began with this skill, the ability to sense the start of something big before the rest of the world saw it. It's not luck, it's training. It's watching the same price patterns form over years until your mind recognizes the rhythm instinctively. Once you can do that, you're no longer reacting to the market, you're moving with it. So when you think about holding for bigger gains, remember this: it begins with recognition. It begins with the quiet, patient observation of a market changing its tone. You can't hold a move you didn't see coming. You can't sit tight in a trend you don't understand. Recognizing that turning point, those first early signs, that's your invitation to the table where real profits are made. Early trend shifts often begin with a quiet change in price behavior, not a big breakout. That's one of those lessons the market teaches only after you've paid your tuition through experience and losses. Most traders want excitement. They wait for the fireworks, the big move, the signal that flashes across every screen. But by the time the market looks obvious, the professionals are already in, and the amateurs are chasing what's left. The truth is, the beginning of every major move is quiet, uncertain, and easy to miss. It doesn't look like a trend yet, and that's precisely why it works. Think about it this way. The market is like a large ship changing direction. It doesn't pivot sharply, it turns slowly, building momentum as it goes. You won't see the turn in a single candle or a single session. You'll see it in subtle shifts, higher lows forming after a long decline, a drying up of volume on the down days, or strength showing up in certain leaders while the rest of the market still sleeps. These are the quiet whispers of change, and only the trained eye catches them. Why does the market behave this way? Because large players, the institutions, funds, and professionals can't move in and out of positions suddenly without tipping their hand. They accumulate slowly. They buy from the weak hands that are still fearful, still scared from the last decline. They're not chasing, they're absorbing. That accumulation phase is what lays the groundwork for a new trend. You won't see dramatic moves yet, you'll see subtle ones, just enough to signal that something beneath the surface has shifted. Have you ever noticed how most traders ignore these small changes? They say, it's just a bounce, or the market's still weak. And that's fine, because the market thrives on disbelief in its early stages. The strongest moves always begin in an atmosphere of doubt. The crowd doesn't believe in the reversal, they need confirmation. But confirmation is expensive. By the time everyone agrees, the price has already moved too far. The early trader, the one who can spot that quiet shift in character, gets the low risk, high reward entry while everyone else is still debating. That quiet change often starts with price stability after a long decline. Instead of sharp drops, you begin to see the market holding steady. The down days lose their intensity and the lows begin to hold. Maybe the stock starts making slightly higher closes. Maybe it stops reacting to bad news. That's a subtle but powerful sign the market stops going down on negative headlines. It means the sellers are done, and the buyers are starting to take control. Even if it's not obvious yet, the next layer of evidence comes from volume. Watch how it behaves. If the declines are happening on lighter volume, but the rallies attract heavier participation, that's strength. It means demand is returning. You don't need to guess. The volume tells you the story. Price is what you see, but volume tells you why it's happening. When you put those two pieces together, steadying price and constructive volume, you start to see the first footprints of a new trend. Another sign of a quiet beginning is the behavior of leading stocks or sectors. While the overall market might still be uncertain, certain names will start acting differently. They'll hold up better on down days and rise faster on up days. Those are your early leaders. When new leadership begins to emerge quietly, it's often a signal that the broader trend is about to shift. Markets are driven by leadership, and when new leaders appear, new cycles follow. Do you remember what it felt like the last time you chased a big breakout? The adrenaline, the certainty that you were right, followed by the frustration of being late. Every trader has been there. The big, obvious breakouts are attractive because they feel safe. But safety in the market often comes at a cost. The true professionals focus on behavior, not drama. They study how the market acts before it looks obvious. They know that price behavior changes first, then sentiment, then headlines. The best part about recognizing these quiet changes is the element of timing. If you can identify them early, you don't need to be perfect. You get the luxury of positioning yourself before the crowd, which gives you both psychological and financial leverage. You can scale in calmly, without fear, because you understand the context. The quiet phase gives you time to plan, while the loud phase forces you to react. Trading from a position of calm observation instead of emotion is what separates the speculator from the gambler. Now think about this from the mindset of wealth building. The great fortunes in trading aren't made from constant activity. They're made from correctly identifying and holding a few major trends. But to hold them, you first need to catch them early. If you always wait for confirmation, you'll forever be late. Early recognition is your ticket to compounding gains instead of chasing them. The earlier you spot the change in character, the longer you can ride the move once it begins. Quiet beginnings are uncomfortable. They test your patience and your conviction. You'll often feel unsure, even foolish, because the market won't yet validate your observation. But that discomfort is the price of early opportunity. The market rewards those who can act decisively on incomplete but reliable evidence. You're not gambling, you're observing. The small changes in price behavior are your clues, and your job is to interpret them with discipline and detachment. Ask yourself, how many times have you wished you'd gotten in earlier? How many times have you looked back at a chart and said, "The signs were there, I just didn't trust them"? That's what this is about. Developing the confidence to trust your observations when the market starts whispering instead of shouting. You won't be right every time, but when you are, the payoff is enormous, because catching the beginning means you can sit through the noise, manage your risk, and let the trend carry you to those bigger gains that others can only dream of. The quiet change in price behavior isn't glamorous, but it's where every great move begins. It's not about predicting the future. It's about recognizing the present more clearly than others can. The market doesn't owe you excitement, it rewards your patience, your observation, and your ability to notice the small shifts that everyone else ignores. Those shifts are where the big opportunities hide, waiting for the trader who can see what others overlook. Higher lows near a key support indicate a possible reversal in trend direction. It's one of those subtle clues the market gives you if you're patient enough to notice. Most traders look for explosive breakouts, dramatic reversals, or clear-cut signals to tell them a new trend has begun. But the market rarely gives such clear signs. It whispers before it speaks. When you start to see a series of higher lows near a well-established support level, that's the whisper of change the point, where weakness starts giving way to quiet strength. You see, the market is a constant battle between supply and demand. When a stock or index keeps testing a support level but fails to break it, that's a message. It means the selling pressure that once dominated is running out of ammunition. Each time price dips down to that area, buyers step in a little sooner, pushing the market back up before it can make new lows. Over time, those higher lows show that demand is beginning to overtake supply. It's not just price action, it's the psychology of the market made visible on the chart. Think about what's happening beneath the surface. The first low represents capitulation, panic selling, fear, exhaustion. The second test of that level might shake out the remaining weak hands. But when the third or fourth test holds higher, it tells you something important. The sellers have lost conviction, and the buyers are growing confident. The market doesn't change direction by accident. It shifts because one side starts to dominate quietly before it's obvious to everyone else. Have you ever noticed how the crowd behaves at these points? Most people are still bearish. They remember the decline that brought the stock to that level in the first place. They can't imagine it moving higher again because fear blinds them. Meanwhile, the professionals, the ones who understand how markets turn, are watching those higher lows form and quietly building their positions. They don't need confirmation from the news. They trust the tape. Higher lows near support also signal something deeper about momentum. Momentum doesn't just stop, it decays. When the downswings become shorter, when the recoveries become stronger, that's the early evidence that momentum is shifting direction. You might not see the breakout yet, but you can feel the energies starting to build. Prices coiling, tightening, preparing for a move. It's like watching a spring compress, quiet at first, but full of potential energy. Now, if you study charts from great turning points in the market, whether it's major indices, commodities, or individual stocks, you'll see this pattern again and again. It's the market's way of building a foundation. Those higher lows form a base, a platform from which the next move can launch. Without that base, any rally is just a bounce. But with it, you have the structural support of accumulation, the quiet buying that forms the seed of the next trend. There's a psychological rhythm at work here. In the early stages, every dip still triggers fear because traders are conditioned by the prior downtrend. But each recovery chips away at that fear. Confidence starts to replace despair. The market, in essence, begins to rewrite its own emotional narrative. That's why these patterns are so powerful. They reflect a real shift in sentiment and behavior. Ask yourself, when you see a stock holding higher lows near support, do you feel tempted to fade it because it's gone too high, or do you recognize the underlying strength? That's the trader's test. The majority will fight the early signs of reversal because they can't let go of the past trend. But the professional watches objectively. He doesn't argue with the tape, he reads it. Another layer to consider is volume. If you notice that each dip into support comes on lighter volume, while each recovery is accompanied by heavier volume, that strengthens the signal. It shows that the selling is losing strength while the buying is gaining conviction. This is what you want to see before a new trend emerges, evidence that the market's energy is changing direction. There's also the concept of time. The longer a market holds its support and continues to make higher lows, the stronger that base becomes. It's like the foundation of a building. The deeper and more stable it is, the higher the structure can rise later. Impatient traders get frustrated during this phase because it looks like nothing is happening. But in reality, everything is happening. The groundwork for the next move is being laid in silence. From a wealth-building standpoint, this pattern teaches one of the most valuable lessons in trading. Patience pays. You don't have to predict the exact bottom, you only need to recognize the shift in character. When you can spot higher lows forming and understand what they mean, you position yourself ahead of the crowd. You're not reacting to headlines or waiting for someone to tell you. It's time you're acting on the evidence the market is already giving you. In practical terms, higher lows give you a clear framework for risk management. You can define your stops just below the recent higher low, keeping your risk small relative to the potential reward. That's how professionals trade, not by guessing, but by structuring each decision around observable facts. When you align your entries with the market's quiet shift in strength, you give yourself both technical and psychological advantage. Do you remember how we talked about holding for bigger gains in that earlier lesson? This ties directly to that idea. You can't hold for big gains unless your entry is rooted in a strong, natural turning point. When you identify those higher lows early, you're not just catching a reversal, you're stepping into the beginning of a potential long-term move. That gives you the confidence to hold when volatility shakes others out. Every major uptrend begins this way. The charts may differ in shape and timing, but the story is always the same. Fear gives way to stability. Stability gives way to confidence, and confidence gives way to strength. The market shows you this transition through higher lows near support. It's the visual signature of a shift in control from sellers to buyers, from despair to hope, from weakness to leadership. The beauty of it is that the market never hides this pattern. It's there for anyone to see, but few have the patience or discipline to act on it. Most want instant proof, a breakout they can chase. But the professional understands that the higher lows are the proof. They're the market's way of revealing that a new story is beginning to form. If you learn to see those quiet, steady steps upward near a key level, you learn to hear the market's most valuable whisper, the sound of a new trend being born. Independent observation beats crowd confirmation every time. That's a truth every trader must learn, though most learn it the hard way. The market doesn't reward agreement, it rewards insight. By the time the crowd agrees on anything, the move is already over. The speculator who learns to think for himself, to trust what the market shows rather than what people say, becomes the one who consistently pulls profits from the confusion of others. Most traders, especially beginners, crave validation. They look for confirmation from news headlines, social media, analysts, or trading communities. They don't feel comfortable acting until they see everyone else doing the same. But in markets, comfort is expensive. The more comfortable a trade feels, the less profitable it's likely to be. Real opportunity hides where others hesitate, where uncertainty still clouds the picture. That's where the market pays those with the courage to observe independently. Independent observation doesn't mean stubbornness. It doesn't mean fighting the market or trying to be a contrarian for the sake of ego. It means developing the discipline to let your own eyes read the chart, your own mind interpret the action, and your own judgment guide your trades. It's not about being right all the time, it's about being early when it matters. The early trader doesn't wait for permission because he understands that the market's message comes long before the crowd notices it. Have you ever noticed how the crowd behaves after a big move starts? At first, they doubt it. Then they question it. Then they rush in just as the professionals begin to distribute. That cycle never changes. It happened in the old bucket shops of Jesse Livermore's time, and it still happens today on every trading screen around the world. Independent observation is what allows a trader to stay ahead of that rhythm. You don't need to outsmart the crowd, you just need to see before they see. The market's true signals are always visible to the trader who looks without bias. Price and volume tell the story. The tape reveals whether demand or supply is winning, but to see it clearly, you must silence the noise of opinion. Every piece of outside commentary adds a layer of distortion to your perception. The more you listen to others, the harder it becomes to hear what the market itself is saying.